Hi everyone, this is Kshitij Agrawal. Nowadays, whether it is business or individual, everyone is dealing in international transactions. So when international transactions are happening, there comes the role whether my international income is taxable in India or not. Double taxation avoidance agreement. This is the major thing which decides whether your income will be taxable in India or outside India. If a country is not having double taxation avoidance agreement, then we will give some relief to the individual that or the business that your income, this portion of your income will be allowed in India because you have already paid tax outside India. Now, what is this session for? I have made a summary, I have made a full detailed master question on this double taxation avoidance agreement where there is no agreement between India and the other country from where the person is receiving the income. Now, come to the question. Mr. KCA, he is a resident aged 62 years. He is a senior citizen and he is earning income from India, Pakistan and USA. Why Pakistan has been taken over here? Because when we talk about double taxation avoidance agreement, then all other countries are taken care of. But the specific provision of Pakistan is missed out by various people. So I have tried to cover all the points over here relating to section 91, subsection 1, subsection 2. So he earned following income during the previous year 24-25 means financial year. And India is not having any double taxation agreement with Pakistan and USA. So his first income is professional income 2.5 crores. He is earning it in India. Now lottery income in India it is 8,000. It is net of TDS. So we have mentioned it net, which means that it has to be grossed up and total income has to be taken as income in income from other sources. Next is agricultural income earned in Pakistan. This is also net. Again, we have to gross it up, but it will be grossed at the rate of tax applicable on agricultural income in Pakistan because that will be the total income what is earned by the SSE, and we will take the same for calculation of taxes or the taxable income. Now, one more point is given over here. Pakistan allowed a reduction of 3.5 lakhs in Indian rupees calculated from agricultural income. So this has to be taken care of because it is not allowed in India, but it is allowed in Pakistan. So this Pakistan impact, this agricultural income impact will come in three places. Now, just to divert from this for a few seconds, how we take the calculation in double taxation avoidance agreement. First, we will take the total income whatever he is earning globally. If he is a resident, whatever income he is earning globally will be taxed at Indian rates. Taxable income will be calculated at Indian rates, tax will be calculated at Indian rates. Then we will see what is the average rate of tax in all the countries from where he is earning the income, and then we will give him the relief on doubly taxed income. So we will calculate doubly taxed income, and then according to section 91 we will give him the relief on that doubly taxed income, what relief should be given to him. So these are the steps we are going to follow. While doing the solution, I will explain the steps once again. Next, coming to the question again, his royalty income from Pakistan gross is 6 lakhs and he is expending 60,000 for earning that royalty income. So his total income is 5,40,000 from royalty. Then business loss. He has incurred some business loss in USA, but it is not allowed to be set off as per US laws. So in India, he is not paying any taxes on it, or we can say he can claim these income expenses, but in USA he cannot claim it. So it is not doubly taxed, or it is not doubly exemption allowed. So we will remove it from doubly taxed while calculating doubly taxed. So 8.5 lakh in INR. Next, he is earning rental income from USA 3,70,000 in INR. For this rental income, he let out the property on 1st Feb 25 and construction was completed on 26/1/25. So, why this construction is relevant and why this paragraph is relevant? See, he has borrowed 45 lakhs on 27th March 22. He completed the construction of house on 26th January 25 and he put it on rent, and he earned 3,70,000 out of that rent. But if he has borrowed the amount from bank, then he will pay interest on that. So that interest, whatever he has paid before completion of construction till the prior year, that has to be allowed to him. How it will be allowed, we will see in the solution. Then he paid some interest during the year also. Stamp duty of the house property as per US laws is 45 lakhs, and the SSC feels that he is eligible for 80 EEA. So we will see how it will apply, how 80 EEA will apply, if whether it is applicable or not applicable. If not applicable, then why? So next income is he invested in shares. Which shares? He invested in shares of Apple Inc., which is a foreign company in USA. He has expended. He has invested the amount on 24/1/21, and he sold shares at INR 1925 on 12th July 24, and 3,500 shares were sold in December 24 at different rates. Why this is important? Because capital gain will come into play. Capital gain 23rd July date is the cutoff date, which is very important. Now, this income was earned by him in USA, so USA also taxability will be there. India also taxability will be there. How we will calculate the relief? We will see. And in USA, it is taxed at 10%. Now, he also invested in 440 shares of Reliance Limited, which is Indian listed company. Now, at on 22nd November 21, and he sold 340 shares at INR 1857 on 6th January 25. STT was paid, so 112A will apply, and he can show it under 112A. Company bought back 100 shares and paid INR 206,000, 2 lakhs to him on 20th March 25. So buyback is happening post 1st October. So some new provision for buyback was introduced in Finance Act 24, which will apply in this case. He paid some municipal taxes. That municipal taxes was not allowed in USA. So we'll see, this municipal taxes is an important point. We'll see how to deal with it. He has received some dividend. The dividend income is given in USD. So rule 115 has to be checked over here. Now what does rule 115 say? That if you are earning any income in USD, then it has to be computed in INR while calculating your tax liability. How it will be calculated in INR? We will take the rate, telegraphic transfer buying rate, or at the last day of the month prior to the month in which the transaction is happening. So in our case, 1st April 24 is related to 23/24. Now if you see, it is given in the question that USA follows calendar year. This information is irrelevant for me. Why? Because this is just for creating confusion. What has to be taken over here? We are calculating taxes as per Indian laws. And while calculating, now the question will come that okay, for Indian tax we are taking as per Indian laws, financial year we will take. But while calculating average rate of USA, we should take calendar year. No, we are taking for the period in which we are paying taxes in India. So for that only we will see what is the average rate of tax in the foreign country. So this dividend is irrelevant for me. Then he received some dividend on 34/24. It is received on last day of April. So prior to that 31st March. March is the 31st March rate we will take. Telegraphic transfer buying rate will be taken. And on 2nd January 25. So 31st January 25 telegraphic transfer buying rate will be taken in these two cases. He paid for medical insurance for his non-resident father, 48,000. If the father would have been resident in India, then 50,000 for medical insurance would be allowed. But here only 25,000 would be allowed. Tax on agricultural income in Pakistan is 20% and on other income is 15%. And tax rate in USA is 12%. Now, see, if you see in both the other countries, Pakistan and USA, there are two different tax rates. Now we have to calculate the actual income and actual tax in those countries and take the rate of tax, average rate of tax for that purpose. Now, next information given over here is cost inflation index for 2021 is given 301, and this is for the capital gain purpose, and exchange rates is given INR per USD at different dates. Only few dates will be relevant as discussed already. 31st March 24 and 31st January 25 is relevant. Rest everything is just given for confusion to apply brain which date should apply. And only TTBR will be applicable, telegraphic transfer buying rate. So 79.5 and 79 is important for me. Rest all the rates are just for creating confusion. Now the person KCA wants to know which regime will be beneficial for. Now, coming to the solution of this question, we have to calculate the taxes in both the regimes and compare which is beneficial for him. Income from house property. From USA, he is earning the house property income and gross annual value was 3,70,000 and municipal taxes paid by him was 13,000. Now, municipal taxes. What does section 23 say? That whenever municipal taxes are paid, local taxes have been paid to local authorities in respect of that property will be allowed as per Indian laws. We are calculating the taxes as per Indian laws. We don't have to worry about the US laws for the time being while calculating taxes as per Indian laws. So gross annual value is 3,70,000 and municipal taxes is 13,000. So municipal taxes, though it is not allowed in USA, but it is allowed in India because it is in respect of the property. Whether paid in India or outside India does not matter, and it should be allowed to us. So 3,57,000 is the net house property income from USA before deductions. Now 24-day standard deduction will be allowed 30% of the income, and 24B interest on loan. Interest on loan, two things are there: pre-period interest and post-period interest, post-construction. Pre-period interest, we allow whatever pre-period interest is paid, that has to be allowed for a period of 5 years to the SSC from the year the asset is completed, the construction is completed. So in our case, the construction was completed on 26 January and pre-period interest was 2 lakh plus 1,75,000. So it will be allowed for a period of 5 years. So 2 lakh plus 1,75,000 by 5, and during the year he paid interest of 1,20,000. That will also be allowed to him. Maximum limit will be 2 lakhs. But in case of pre-period interest, maximum limit applies only in case of self-occupied property and not in case of let out property. But in our case, it is 1,95,000, so it is allowed anyways. So 3,02,000 is the total interest on loan. So his net income from house property is 54,900. This was the income he earned from USA, but if this is the tax, if he pays taxes in India, while taking the taxes in USA, we have to take 357 if municipal taxes is allowed in USA. Why? Because these two, 24A and 24B, is not allowed in USA. These are not allowable deduction in USA, so it will not be allowed while taking taxes in USA. And municipal taxes is also not allowed. It is specifically given in the question, so this will also be not allowed. And instead of 357, we will take only 3,70,000 as income in tax in USA for tax calculation purpose, average rate of tax. Coming to business income, he is earning a professional income of 2.5 crores in India, and business loss in USA is 8.5 lakhs. So business loss in USA, though it is not allowed in USA, again I will repeat the same line that we are calculating taxes as per Indian laws and we don't have to worry about the US laws for the time being until we calculate the average rate of tax or doubly taxed income in USA. So moving forward, the business loss will be allowed from 2 crore 50 lakhs and his net business income will be 2 crore 41 lakh 50,000. These two heads of income were very simple and we calculated it. Now, moving forward to capital gain. Capital gain, there are three things. We have to take care of three things only for capital gain income. Deductions and allowances, exemptions, whatever are there, we will see. We have to be very careful with capital gains. So, Apple Inc. shares, whatever is sold by him, we will tax under 112 because it is not listed in India. And in 112 also, we will see whether transfer is happening prior to 23rd July or on or after 23rd July. So, shares in Apple Inc. 112, if sale is happening before 23rd July, then in India, if it is long term, we will give the benefit of indexation to him. If we come to the question for the shares, if you go by point number 8, on this page itself it is given that he invested in 7,000 shares of Apple at 1,600 per share. So that is his cost of acquisition for whole. And he sold 2,000 shares on 12/7. This is prior to 23rd July. So on this, he will be given benefit of indexation and he has to pay tax at 20% on this income. So 1925 is the sale price for 2000 shares and cost is 1600. So 1600 will be indexed. Same way it is done over here. Full value of consideration is 1925 and indexed cost of acquisition is and indexed cost of acquisition is 2000 into 1600 and indexation of that amount. So the cost will be 3859,136 and it will exceed my fair value of full value of consideration. So there is a loss of 9000 in this case in India. But while calculating average rate of tax in USA, we will take full value of consideration 1925. But cost of acquisition will be 2000 into 1600 only, and no indexation benefit will be given. Why? Because indexation applies only in India and there is no indexation in USA. So that is why we are not giving indexation benefit in USA. We will see this while calculating average rate of tax in USA. So there is a capital loss on this. Sale on or after 23rd July. Few shares, 3500 shares were sold on or after 23rd July, which is December, at 2147. So full value of consideration this much and cost of acquisition is 1600 and tax will be applied on this directly. So 2147 is the sale value and cost of acquisition is 1600. So it is plain that 19,14,500 is the capital gain for this income. Net capital gain after set off will be 19,05,364 because 112 we have set off 9136 loss over here. This is the net capital gain from shares invested in Apple Inc. in US and income received in US. Now coming to Reliance Limited. Reliance Limited shares have been acquired by him and it is long term. So 112A will apply in this case and full value of consideration is given in our question. For 440 shares, he paid 800 for buying the shares and he sold 340 shares at 1857 and remaining 100 shares were bought back by the Indian company. So, and company paid 2,06,000 to the SSE and buyback happened post 1st October. So we'll see the buyback provisions. Before that, we'll calculate the taxes. So full value of consideration is 340 into 1857 and cost of acquisition is 340 into 800. This is also plain, but from this now we have something called buyback of shares. What is the buyback rule? If any company, Indian company, buys back its own shares on or after 1st October 24, then whatever amount the company pays for that buyback will be taxable in the shareholder's hand. Shareholder has to pay tax on that. So in this case, shareholder is paying the tax on 2,06,000 because he received 2,06,000 for buyback of shares. Now, what about the cost he has incurred for buying those shares long back? Because when he purchased those shares, he was not aware that the company is going to buy back its shares in the near future. So the department told you can claim it. It is a normal short-term capital loss, long-term capital loss for you. If it is in the nature of long term, if it is in the nature of short term. Accordingly, whether it is long term, if the period of holding as on date of buyback is more than 1 year for listed security, then it is long term. If it is up to 1 year, then it is short term. More than 1 year, long term, up to 1 year, short term. So whatever cost he has incurred, he can claim it, and if it is long term, then from the long term capital gain, he can set it off. So in our case, 80,000 is the total because 100 shares are bought back and Mr. KCA purchased at cost of 800. So 80,000 is allowed to him to be claimed. So his capital gain on this 112A will be full value minus cost minus the buyback value, whatever he has bought back the shares. So buyback benefit is given to him and capital gain will be 279,380. So the net capital gain will be 21,84,744. Earlier there was a linking error. If you see few seconds back, that it was coming as the link of 1905 minus 9136. Now it is corrected. This is 2184. This error was noticed after formatting the Excel file, but the explanation remains the same for capital gain. All the places. Moving forward. Income from other sources. Lottery income in India is 8,000. Now, this was given as net income, but while calculating tax, we have to take the gross income, what is taxable. So, we will take 70% gross income for this, and it will come to 11,429, 8,000 by 70%. Then agricultural income in Pakistan, again this is given in net, and the tax paid in Pakistan is 20%. So, we have to gross it up at the rate on which it is taxable. So basically total income is 11,25,000, which has been netted to 9 lakhs. So total income which is taxable, if we say it is 11 lakhs, then only TDS or tax whatever it is there, it will be applied on it. Royalty income is 6 lakhs and 60,000 expenses incurred. So these three income is there in other sources. Total is coming to 1676,429. Coming to dividend, in dividend there was a typing in the question. It was 2-1. It should be 2-2. 2nd Feb 25. So he received two dividends. First one was received on 30th April 24 and second was received on 2nd Feb 25. If you see in the question, the point number 10, it is given over here, and 2nd Feb 25. Now, the rate will be taken for 30th April, last day of the previous month in which the transaction is happening place. So it is 31st March, and telegraphic transfer buying rate. And in second case, 2nd Feb is the transaction. So previous month is January, last day of January, which is 31st January, 79 is the rate. Accordingly, it is taken over here and dividend is computed. Now, on buyback, he received 2,06,000 from the company. 100 shares are bought back at 206. No expense is allowed, and fully it will be taxable under income from other sources. So total dividend income will be 2,41,000 and other income will be 1676. So total income from other sources will be 19,17,000, which will make our gross total income to be 2 crore 83 lakhs. Till now, whatever gross total income is there, in old and new, in both the cases it is same. Moving forward to deductions. Chapter 6A, specific deductions are allowed under new regime, but all are not allowed. So we have earned royalty income. The person KCA has received royalty income. Royalty income is allowed under old regime under 80 QQB, but it is not allowed under new regime. So we will take the benefit of 80 QQB and 80D, health insurance for non-resident father. He is a senior citizen, so his father might be a super senior citizen. So if the senior citizen person parent is non-resident, then only 25,000 is allowed. The enhanced limit of 50,000 is for resident senior citizen parent. So 3,25,000 in old regime it will be allowed, but it won't be allowed in the new regime. So once we reduce the deduction, we'll get the net taxable income of 279,82, and in new regime it will be more, 2 crore 83 lakhs will be the income. Moving forward to calculation of taxes. Two kinds that taxes will be calculated: special rated and remaining income. What are special rated taxes? Lottery and capital gain. Now, two things are there. In this case, income is crossing the mark of 2 crore. So surcharge will also be applicable. But we will see special rated income and normal income. For purpose of calculation of taxes, special rated is lottery and capital gains. Capital gain means all three sections: 111A, 112A, 112, and lottery. But dividend and other income will come under normal slab rate for tax purpose. While computing surcharge, we have to reduce lottery income and capital gain income to compute our normal income. So same thing we have done: total income minus capital gain minus lottery income. So we get 257, and tax at slab we will apply, and total tax before surcharge and cess will be 78 lakhs. Accordingly, it will be calculated in new regime with the same formula. Now coming to surcharge, how surcharge will be calculated? For the purpose of surcharge, capital gain and dividend is treated as a special rated income. So dividend income tax is charged on normal slab. Now this 78 lakh 6,000 tax includes special rated plus remaining. The remaining is 75/45. This will include taxes on dividend income of 2,41,189. So we have to take the proportionate surcharge for dividend income. So we'll see how surcharge is calculated on capital gains first. In capital gains, if you see here, capital gain tax is 2,57,468. So we have given surcharge on that. Surcharge on capital gain is limited to 15%. What is the surcharge rule? If your income crosses 2 crores and total income and your capital gain after reducing your special rated gains, capital gains and special rated income from your total income crosses 2 crore, then we have to take 25% surcharge on remaining income. In our case, if you take the total income 2 crore 79 lakhs minus 21 lakhs minus 2 crore 2,41,000, then it is crossing 2 crores. So on remaining income, the tax on remaining income will be charged at 25% surcharge. But this tax also includes dividend income. So we have to do proportionate calculation. In this case, this 78 lakh is for 2 crore 79 lakhs. So for 2,41,000, how much tax will be there? It will be 67,000. The surcharge on this will be restricted to 15%. So the surcharge will be 10,000. So on the remaining income, similarly we have taken proportionate basis. Then we have taken all other income except capital gain and dividend income. Total surcharge will be 18,53,000. Similarly, it is calculated in new regime. Cess will be added and total tax liability will be 1 crore 47,000 and 99,96,000 in old and new regime respectively, before giving relief under section 91. Now this tax is calculated, but there is a point why while calculating capital gain we have taken 80,000 loss on buyback of shares from the 112A income, because it is in the nature of 112A. It cannot be taken from 112. This income is it can be in the nature of 112A or 111A. Then only it will be allowed, because it is for Indian companies. So it cannot be 112 if the company is not listed. So unless a listed company is buying back, you cannot claim it as loss. So which means 112 companies, whatever you are taxing, whatever shares in share income you are taxing under 112, cannot be given the benefit of buyback of shares. Coming to the relief, before computing the relief, we have to calculate three things: average rate of tax in India, average rate of tax in foreign countries, and doubly taxed income. Then we can compute the relief rule and we can find out. Come to the working notes, how we have calculated average rate of tax and doubly taxed income. In India, we have two regimes, old and new regime, but Pakistan and USA has only single thing. They do not have any new regime, old regime. So accordingly, in India, our income is 2 crore 79 lakhs, old, and in new it is 2 crore 83 lakhs, and accordingly tax is there. So we got the rate of 35.9 and 35.31. This full calculation we have done. So this is just a summary of that calculation. Average rate is calculated in this manner. Coming to USA first. What is the income we are earning from USA? House property, dividend income, and shares of Apple Inc. USA. See how income is computed in this case. While calculating capital gain on Apple shares in India, we were taking indexation cost benefit for shares sold prior to 23rd July. But this is not allowed in USA. Accordingly, once we go for capital gain calculation in USA, what is the capital gain? First, you'll see that this is a rough idea. Capital gain will be 38 lakh 50 minus 2000 shares and cost of acquisition was 1600. This is the capital gain for sale before 23rd July. For the sale after 23rd July, it is plain. No indexation is given in India. That is plain 75 14,500 minus 56 lakhs. So our ultimate capital gain in US is 2564 and this is taxed at the rate of 10% as given in the question. Now what about the remaining income? Dividend income of 35,189 is there and house property income of 3,70,000. Why 3,70,000 and not 54,900 or 3,57,000? What happens over here? In USA, it said that municipal taxes are not allowed. So we cannot give the benefit of municipal taxes. And standard deduction and interest on loan is not allowed in USA. That is Indian deductions. So whatever income is there in USA has to be taken only. So 3,70,000 is earned in USA. So that 3,70,000 plus your dividend income of 35,000, 4,05,000 is taxable at the rate of 12% as given in the question. For other things it is 12%, capital gain it is 10%. So accordingly, we will calculate the tax rate and we will add it to it. Same way it is done. This is the capital gain portion and other things B7, B40 and B41 are dividend and house property. Accordingly, we have calculated taxes on capital gain at 10% and 12% on remaining income. So we got average rate of 10.27. Coming to Pakistan, for other income, two incomes are there, royalty income and agricultural income. Once we earn any income other than agricultural in Pakistan, it has a similar rule that tax will be computed accordingly. But once agricultural income comes, double taxation relief gives section 91 subsection 2 gives special benefit for Pakistan. How income is calculated? B37 minus 3 lakh. Actually, this is saying about agricultural income in Pakistan 11,25,000 and as you remember in the question 3,50,000 was allowed as reduction in Pakistan. So this is allowed. This is the income in that country plus royalty income 5,40,000. There is no restriction on claiming the expense on earning royalty income. Accordingly, we will calculate taxes. Two different rates are given. Whatever taxable agricultural income is there, it will be taxed at 20% and remaining at 15%. So same thing is done over here. We got the rate of 17.95%. So these are the average rate of taxes in all the three countries. Coming to doubly taxed income. In USA, it is plain house property. What is doubly taxed? Capital gain and dividend income. So in house property in India we are paying tax on 54,900, but in USA we are paying tax on 3,70,000 as municipal taxes are also not allowed over there. So a doubly tax will be only 54,900 because this is the only amount on which we are paying tax in both the countries. Coming to capital gain. In capital gain, net capital gain from USA as per Indian laws is 19 lakhs, but as per US laws it is 3850 minus without indexation cost. So that will be 2000 into 1600 and then we add 19 14 500 So total 2564 is the taxable capital gain in US, which means in US the person is paying tax on 25 lakhs, but in India it is 19 lakhs. So doubly taxed is only 19 lakhs. And dividend total amount of 35,000 is taxed in both the countries. It will be same in new and old regime. Now coming to the other country, Pakistan. Here in agricultural income, it is plain that in Pakistan the person is paying tax on 7,75,000 agricultural income, but in India he is paying tax on 11,25,000. So 7,75,000 is the amount on which he is paying tax in both the countries. So doubly taxed will be 7,75,000 only. In case of other income, if the person opts for new regime, then he is paying tax on 5,40,000 in Pakistan and also in India. But if he goes for new old regime, then he gets a benefit of 3 lakhs in old regime. So in India he is paying royalty tax on 2,40,000 in old regime. So that is only doubly taxed if he follows old regime. So total doubly taxed in Pakistan will be 1015 and 1315 as per the regime. Coming to the relief, now doubly taxed income and average rate of tax is computed. Coming to the relief, USA has a simple rule. The relief is lower of average rate of tax into doubly taxed. So whatever doubly taxed is there into lower rate, whether in US or in India. So it will be, we calculated doubly taxed is 1145. Rate of tax in US is 10.27 and in India under both regime is 35.91 or 35.31. So it will be 1145 into lower rate. So if you are taking old regime, then it will be 10.27 into 35.9 or 35.9, whichever is lower, and new regime 10.27 or 35.31, whichever is lower. So accordingly it is calculated at 10.27. Now coming to Pakistan, their two rule follows. If it is any income other than agricultural income, then the rule is same, doubly taxed into lower rate, whatever is lower. But if it is agricultural income over there, then the rule changes. It says tax paid in that country. It says relief will be lower of tax paid in that country and Indian tax rate on such income. What does such income mean? Such income mean agricultural income which is taxable in India, because agricultural income taxable in India, because you are talking about the income. The income is 11,25,000 what we have considered. So the tax paid is the doubly taxed is 7,75,000 in case of agriculture, and tax paid there is 20%. If you calculate here itself, so 1,55,000 is paid in Pakistan, but in India it will be 11,25,000 into 35.90%. So the lower of this two will be allowed as relief. Same goes with the new regime. The rate will be 35.31. Again we will calculate, so it will be lower. The Pakistan tax will be lower. In case of other income, it is plain, as we discussed now. 17.95 is lower in both the cases, old or new regime. So accordingly it has been allowed. After this, the net taxable gain, net tax payable is coming as 97.31 in old regime and 96.27 in new regime. So the new regime is beneficial for the SSC and he will opt this regime and he will pay taxes under this. This Excel and PDF for this file will be made available on Telegram, and Telegram link will be provided in the description.